Okay, I want to have a look at the relationship between the formula for correlation and the formula for covariance. So in this example here, I've got a portfolio constructed of a basket of stocks and a basket of bonds. So given the following data, which I'm going to enter now, we've got a question here on the right, which is given a correlation coefficient of negative 0.5, so a correlation of negative half between the two asset classes, find their portfolio variance. So I'm going to put some weights in here. So the weight of each asset in the combined portfolio, I'm going to put half equities and half bonds. So it's a mixed portfolio of equities and another mixed portfolio of bonds combined for a larger portfolio of a half-half split, equities and bonds. The expected return on the equities portion is 7.5%. The proxy for risk we're using is the standard deviation, and I'm going to enter 14% standard deviation on the equity portion. On the bond portion, the input that I'm going to use is a 5.7% standard deviation. The expected return I'm going to use is 4%. Okay, so given these values and given a correlation coefficient of negative half, negative 0.5, find the covariance. Okay, so the formula for correlation is, well, first of all, correlation is equivalent to the R value for the relative pair of S to B. So the correlation is the R value between S and B when you do a regression between the two. So R to the S and B, which is minus 0.5, is equal to the covariance between S and B divided by the standard deviation of S multiplied by the standard deviation of B. So given this and this, if we rearrange the formula, we can multiply both sides by the standard deviation of stocks, S. So the S here represents stocks and B bonds. So multiply by the standard deviation of stocks and the standard deviation of bonds, so we get the R value of S to B multiplied by the standard deviation of S multiplied by the standard deviation of B is equal to covariance between S and B. So if I switch the formula around, we have covariance as the quantity that we're aiming to find equals regression of S to B multiplied by the standard deviation of S multiplied by the standard deviation of B. And if we input the numbers, we've got so the R value we're using is negative 0.5, which we were given in the question. That multiplied by the standard deviation of stocks, we've got it above in the table, we've got 14%, so multiplied by 14%, and that multiplied by the standard deviation for bonds, which again is above in the table, we've got an input of 5.7%, so that's multiplied by 5.7%. And so if we work through the numbers now, we've got negative 0.5, negative 0.5, negative 0.5 multiplied by 0.14 multiplied by 0.057 gives us a covariance of 0.00399. So roughly, negative 0.00399. And that is the answer. Covariance between S and B is equal to minus 0.00399.